Hi everyone, welcome to the Timing Research Show for June 1st, 2015. Today we will be discussing the 88th weekly report from Timing Research. So if you haven't had a chance to look at this yet, just go to TimingResearch.com/reports. If you're new to Timing Research, basically I'm building my name's David Cosmeter, I'm the creator of Timing Research. I'm building a crowdsourced sentiment indicator. So each week I send out a survey to all subscribers, ask questions about the markets, what they think about what's coming up and current market conditions, and then I compile that data and publish the report on Sunday evening, and we do the show on Mondays. So normally I have Dave Landry here to guest host for me, but he's having some computer issues right now. So I have Geoff and Glenn here. So Geoff, let's start with you. You want to talk a little bit about Market Gauge and what you guys do?
Sure. First, thanks for having me on, David. And this is Geoff Bysshe from MarketGauge.com. And I have been trading since about 1990. Started as a floor trader trading commodities, but have since moved to stocks. And Market Gauge has been around since 1997. And Market Gauge was really developed or started when my partner, Keith Schneider, and myself were at a hedge fund developing tools to figure out what the markets were going to do. And we found other professionals wanted the tools, and we started distributing them. So whatever it's been, since 1997, can't do the math in my head, we've been doing that as well as helping active individuals. So if you want a better taste of MarketGauge.com, you can check it out, and there's also a free area under MarketGauge.com/tutorials. And that's about it.
Okay, great. Thanks, Geoff. And Glenn, if you'd like to tell us a little bit about yourself and Pacific Trading Academy.
Yeah, thanks again, David, for having us here. I'm kind of the opposite of Geoff in terms of how I started. I started on the stock side as a broker at Merrill many years, about almost 35 years ago, and worked most of my career in New York City or in the environs. And then I guess about 3 or 4 years into that, kind of transitioned over to the derivative side. So I still, to this day, trade in my own accounts, primarily futures, and I do a lot of Forex as well, especially in the last 3 or 4 years. I've been teaching with Pacific Trading Academy since their inception, which is about between 14 and 15 years ago. And what I do is mentoring one-on-one, and I've worked with all levels of traders, beginning traders, experts, and everything in between. And I more or less tailor curriculum, given whatever tools I've acquired over the years, to the individual investor or trader. In my own trading, again, primarily I'm focused on short-term E-mini and Forex, and I'm primarily a technician. Curiously enough, I started on the fundamental front, but for the most of what I do, it's technical, with an emphasis on trend, timing, and Elliott wave. So that's kind of the cursory overview of my approach. But again, in terms of what we do as an institute, we're educational, and we have various programs that cater to different levels and different interests of our students. So that's kind of the quick overview.
Okay, sounds good. Thank you, Glenn.
Great.
And Jim Kenney of OptionProfessor.com is supposed to be here as well, but looks like he's having some computer problems as well. But Dave Landry, are you there now?
Yeah, I'm here, and just give me 1 second. I'm going to email myself, or if you don't mind, email me the link to the show, and if we get a chance, I'll switch computers midstream, because it looks like this one's running a little slow for some reason. Or I might be able to do it myself. 1 second. I mean, you guys hear me okay? Is the bandwidth okay?
Yeah, it sounds good.
Oh, okay. Well, I guess we'll go ahead and we'll go with this for now. Let me email myself the link just in case.
Yeah,
No, it looks like it's trying to look. It's crashed. Yeah. Okay. Okay.
Right.
Okay. I'm going to switch computers. Okay. Go ahead and ask Geoff the first question, and while you do that, I'll go ahead and switch computers.
Okay. All right. Geoff, the first question on the report is question 2 from the survey. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower this week from, that's wrongly worded there, but yeah, from today's open to Friday's close?
To Friday's close. So, well, normally I wouldn't be as focused on a 1-week move, right? But to answer the question, I don't know if you brought this out in any of your data, and I could be wrong, but I looked at this and found it interesting that this week's results had the lowest number of bullish sentiment since the middle of May last year. It also had the highest level of bearish sentiment since that same week. So, based on the sentiment of this particular report, I think people are just way too bearish. So, and I wouldn't say this in a bubble. I'm cautiously bearish, but more so bullish. So and we have the benefit of today's action so far. I think today's action is exactly what we're likely to see. And after the flush so far this morning, I'm going to say we're going to end the week higher. I think people are too bearish. It's reflected in your report. I think the action we saw this morning is typical. And if I have to do a 1-week outlook, I'm going to say up. Multiple weeks, that might be a little different, but 1 week, I'm going to say up.
Yeah, the sentiment move has been interesting the last couple of weeks. It was really high, or really bearish, really bullish a few weeks ago, and then it's been gradually dropping, and the average confidence of the bears has been steadily increasing until it was finally down last week. The markets. Okay, so you said higher, and
yeah, I mean, unless I looked at it wrong, if you just look at the raw numbers, we haven't seen a number this low since, like I said, May of 2014 for the bulls. We haven't seen a number this high for the bears since the same week.
Yeah, it is. It's been a long time since it's been this bearish. So, all right, thanks.
David, go ahead and talk to Glenn too, and I'm gonna try to get everything resolved here if you don't mind.
Oh, okay. Oh, and what would you rate your confidence at, Geoff?
All right, you have to remind me about the scale here, because I remember last time. It's like,
yeah. So 0 confidence would mean that you're it could go either way, 50-50. You think it's the probability is 50% either way. So and then 10 would be you think there's a 100% chance.
Well, as a trader, I'd never give anything 100% chance, so I'll give it a 7.
Okay. Sounds good. And all right, let's move on to Glenn for this week. Do you think it's the market's going to move higher or lower?
Well, for the reason that Geoff just cited, that would tend to be I would tend to agree, and that would be a bullish component. I'm gonna say lower though, and here's why. I see the trend that's developing, and from a sentiment standpoint, I want to put that in a context of my next projected time point, which I have worked out to be the end of this month. Specifically, it comes on a Sunday, June 28th. So whenever I work out a time point that happens to be on a day when the market's not trading, I'm necessarily going to go to the next surrounding or the closest day. So Monday the 29th, my last time point that I projected for the equity sector in the U.S. happened to have been last Monday, the holiday, Memorial Day. So essentially, I look at it and I look at what we've seen, the structure of the market. the broader index, and I primarily follow the S&P. So essentially, the top that came in on the 19th, I think, more or less correlates with the turn that I had projected to come in on the end at the last Monday. So essentially, my overall longer-term view for, in terms of a month, is lower prices, lower equity prices. So the idea is, I'm aware of what the lower, the more bearish sentiment, and that will typically correlate with the move up. I just think we have a little further to go. When I put it in the next, if I think we're going to move down for the next 4 weeks, I think that would suggest an increased amount of bearish sentiment before we hit that bottom and respond accordingly. So I guess the quick answer is I don't know that we've seen the threshold or a breakdown below that threshold of bearish sentiment that would constitute a bounce to the upside. And as such, I would expect lower prices. By the end, and this is not the question you're asking, but kind of to give it some context again, I can see us by the end of the month at 2057 as a number that I've worked out in terms of price. So between a price and a time, assessment, 2057, 2059 range between now and the end of the month. But again, for the end of the week, lower prices towards that ultimate longer-term projection. But and then I will agree with Geoff. My confidence would be about 7.
Okay.
Okay. Dave, can you hear me now?
Yeah, sounds good.
Okay. I might have to try to switch back in a second, but let me just jump in for now. As far as up and down, I think we will head higher this week. I guess I'm not super confident in that. Maybe I'll give it a confidence of about 6. And I like what you guys said about the sentiment and what I've seen. And sometimes it's hard to quantify these into actual trades, but what I've seen with this market, at least over the last couple of months, is every time there's a little bit of a sell-off, it's like the Chicken Littles come out, like it's the end of the world. And every little sell-off is not the end of the world. And I did some research. I think it was like after last week's show, I did some research. And a top is normally more of a process than an event. And it feels just the opposite because you have all these market crashes. But these market crashes really don't come right off a top. You have the new high, and then the market kind of messes around a little bit. You might get a little retrace back up, and then eventually it tops out. And the other thing, too, is a longer-term trend. If you look at the 200-day moving average, we've only had like 5 days of daylight, meaning that the highs are less than the moving average over the past couple of years. And during that period of time, it's going up about 80%. So I'm going to continue to err on the side of the longer-term trend. When we get to the next question, provided my computer's still functioning properly here, I'll have some more things to say about developing events and all. But speaking of which, Geoff, let's go to you. What developing events, and they can be technical. Okay, I'm sorry. Oh,
I think Jim, are you there now?
Yeah, I have. I had a little technical computer problem myself, so I apologize for being a bit late here.
Looks like we got some gremlins this week. Okay, Jim, let's catch up with you. First of all, up or down this week? Since you're a veteran of the show, I think you know the question. You have the board. Yeah. And give us your confidence on that on a scale of 0 to 10.
Well, I am still a believer that the market is in an overall uptrend as far as these moving averages that I follow. So again, that's one of the main reasons it's been so difficult, I think, to get the thing to go down. I mean, the transportation average has been totally in the fade mode, and my experience historically is the stock market follows suit. Now, having said that, we've had a hard time getting this baby to come down, and then, of course, a lot of people are panicked about Greece not getting their money or getting their money. So, personally, I think it should have a correction, but my confidence level is not extremely high because these moving averages seem to be dominating the market as opposed to the realities of some other indicators that I watch, like the transports, to name one. So I'm going to say down this week, but I'm also going to say my confidence is dodgy because we've got cross currents. Some things are deteriorating, so you should have a correction, and the VIX is jumping up a little bit, so you should have a correction. But those moving averages have really, that I follow, have really kept this market from falling. So it's down, but not high confidence.
Okay, well, go ahead and give us a number on that confidence.
It is 60.
60. Okay.
6.
Okay, Geoff, let's go to you. What developing events, they can be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Um, well, mine are all technical. I mean, I like to look at the earnings. I like to see how not earnings. I like to see how the markets react to the jobs data, but all that's the end of the week. And I think in terms of looking at how markets react, there's a couple of really interesting things to keep an eye on. Everybody's focused on the transportations. You know, it's already been mentioned here, and I would completely agree that the downtrend there is negative. However, when I look at markets and divergences, a negative divergence for me is not really negative until the market that you're worried about, in this case the S&Ps, starts to break down too, because I'm not trying to catch the top. So what I think could be kind of an interesting left field play for this market to blow up to the upside would be for something really terrible to happen in Greece. I'm not even sure what that could be at this point. It seems like
the bomb's already blown up, you know.
It's already blown
that
up.
movie.
It's such a mess. So the best scenario for the upside of this market would be that something we didn't even expect so bad happens in Greece, and I happen to be long the Greek stock market.
I am too. You long GREK?
Yes,
Yes.
But admittedly, I've been in it for a while, so I am sitting on profits, and if I wasn't sitting on profits, I wouldn't be as confident in a position. That said, I think there's an opportunity for something really bad to happen in the Greek news, and then the Greek market goes up, and then everybody turns around here and says, holy whatever, if that can go up on that news, why can't I buy the U.S. and then the U.S. explodes higher? So that's one thing I'm watching for that reason. The other thing that I'm watching are the biotechs, the IBB. And I think, you know, it's got a nice consolidation over the last several days, maybe a couple weeks, at a key point. And I think whichever way that breaks will probably tell you which way the market's going to go. So if the IBBs break and the market goes that way, I would follow it. And then the last thing I'm looking at are the bonds, and kind of wondering whether or not the bonds, the TLTs, may have put in a bottom here. That didn't work out so well for me this morning, but I was out quickly. But I think if the bonds turn around and move to the upside, that could surprise people, and it could be a good trade there. And we'll talk about later, you know, what I look for a hedge, and the bonds are one of those things. So if the stocks start to really sell off and the bonds start to really rally, then I'll think the sell-off is for real. So that's what I'm looking at.
Okay, good stuff.
Yeah, if I just want to chime in, you know,
Jump in, Jim.
Like I was saying, my confidence level is dodgy because, as he was saying, we don't have price confirmation of weakness. You'd have to really start taking out 2040, and then of course, you know, the 2020, and then the 1980 area to really confirm some type of momentum on the downside, and that's just not happening right now, and that's why it's so difficult to be selling a market that refuses to drop.
Amen.
Yeah, I agree with you completely.
I agree too. You know, that's one of the problems is we don't have enough controversy on this show, so it doesn't look like we have it this week. But I agree fully, Jim. And you know, my nickname, I don't know if you know this or not, my nickname is Trend Following Moron. If it's going up, I'm a buyer. If it's going down, I'm a seller. And you know, after about 10 years of fighting it, I decided, you know what, I'm just going to follow this trend, and that's what I'm going to do.
Right.
All right, Glenn, you're up next. What developing events, they can be technical or fundamental, will you be watching out for that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Yeah, the only thing I agree as Geoff and I think Jim mentioned in the last few minutes or so, that's an obvious fundamental factor. I would add to that on Friday, I believe OPEC meets, and so I'm going to add that as a fundamental factor. And again, I find that kind of curious because again, from a timing standpoint, I projected some time ago, today of all days, June 1st, to be a turn for energy or oil in particular. My way I'm interpreting that is that today for the next, I'm kind of putting that in or looking at that as a window rather than a specific time point within which I expect some development to occur in the energy sector. And so using that as another potential event, watching or thinking in terms of, from an intermarket standpoint, how the other sectors are going to respond. My guess in terms of tracking the news and so forth and policy is that the Saudis are going to maintain the policy. At least I'd be very shocked. I'd give it about an 85% expectation that they're going to maintain current levels of oil production. If any change, I would expect it may be a slight increase. And so using that or incorporating or thinking about that as another factor that would impact the world markets. I am kind of, at the risk of acquiescing to agree with everyone. It is a little dodgy here because I'm getting conflicting news in terms of or indications on the stock market. So I'm almost tempted to want to reduce my confidence level to about a 6, but
too late.
Yeah, for the sake of being controversial.
There's our controversy.
Is it me, or if you look at the and again, for making broader forecasts, I look out weeks to months to quarters to years, so it's kind of hard to pinpoint, where the market's going to be at the end of the week. The medium term, I can do the short term like intraday or longer term, but week to week is a lot more challenging for me at least. But is it me? What I was going to say is everything from either December 5th or the higher top on December 29th through that peak that came in on May 19th, it looks like a rising wedge type structure. I am longer term, going out to the end of the year, I'm bullish equities in the U.S. at least. And I think we got to look at it in the context of what's going on internationally. I think we're going to see falling energy prices. How the markets will respond to that, I'm not certain. I think I'm bullish the dollar, and I'm long in dollar-yen positions. So from an intermarket standpoint, that would suggest lower energy prices. What impact that has on stocks fundamentally, I'm not certain. I think it's a two-edged sword. There's a mixed reaction. But again, the two major fundamental events that I would focus on this week are the Greece situation, obviously. I think more or less because that's been going on for so long, and I know they have to reach a resolution, I think, by the end of this month, or else, whatever. But the latest reports I'm reading on that are that if it's not going to be that much of a contagion, whether Greece is no longer a part of the EU or whatever, but I think it's just being absorbed. So whatever impact it has, and at whatever point in time they will reach a final resolution on that, I don't know. It's kind of been played out, I think. I think the bigger issue could be by the end of the week what happens out of OPEC, fundamentally. But again, I kind of consider those and try and figure out how that's going to resolve or not resolve or reconcile with the technicals. So again, I expect a shorter term, in my time, when I say short term, meaning between now and the end of the month, a correction in the stock market. But after that, I think we're going to see new highs as we, if to any extent I see that scenario played out. So
yeah,
that's
I think with the Greece situation, as you pointed out, I think after all is said and done, a lot more is going to be said than done.
Yeah.
Jim, let's go to you next. What developing events, they can be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, I would say a couple of things. I've been watching the China market, Shanghai 180 and whatever, and it seemed to me like last week could have been a blow-off top in that area. And I was doing some longer-term graphs, and these are very broad strokes. But we went up towards about $6,000 in the late 2000s. We jumped all the way down to 2,000 on that China market, and then it recently went up towards the 5,000 area. And it didn't really like the altitude so much on it. Now it's up today, but I'll be monitoring that. And I guess there's a stock out there called Yang, Y-A-N-G. That would be something to monitor and keep an eye on, to look at, to get an idea. Because if that market were to really have more significant drops, I think it might have obviously a little bit more of an effect, or it might have more of a vibe out there to sober up the U.S. markets a little bit. The biggest things right now, though, is obviously the oil prices, and the bonds look like they're getting tagged pretty hard today. So if oil were to drop sharply and the bonds were to really go into a major fade mode, that might be the match that needs to be lit to get this stock market to cooperate with the bears to come down just a little bit. Otherwise, again, if the news comes out the other way and the volume is very low, so if everybody is short and they all got to cover the same day, market makers raise those offers and we go blowing out the highs.
Amen.
So, basically that's why they say don't short a dull market, and this thing gets any duller, I'll need no-dos to stay awake watching it.
All right,
Anyway,
I'm gonna try to switch back, jump to the other computer. So I'll come back to my answer. And while we do that, Geoff, the question of the week is, what sort of hedging or portfolio protection strategies do you implement in your trading plans? And I'll be back in about 2 seconds. So go ahead and start answering that, and I'll be right back.
Okay. Well, I don't spend a lot of time trying to hedge myself with options, so I'm gonna take that off the table right now. What I do like to do is look at the relationship between the bonds and the stocks, and use that in such a way that when the market really gets ugly, when stocks really get ugly, the market tends to run to the bonds or the TLTs. And so for the longest time, this has been a great way to kind of be long something when the markets are iffy. Now, admittedly, right now, I think that interest rates probably have turned and are going to edge their way higher rather than lower, as they've been doing for 30 years or so. So I'm not so sure how that relationship is going to continue to play out, but in significant down days, I'm sure running to the bonds would be one good way. The other way, and again, this is depends on the situation, but now is the situation, is the VIX. Just when the VIX gets depressed, when I say VIX, I'm talking about just buying the VXX. When that gets depressed, what happens is when the stocks start to go down, the percentage move up you see in the VIX far outweighs the move you see down in the stocks. And if the stocks get nervous about going down, the VIX doesn't collapse because it's already collapsed. So if you look at the chart of the VIX right now, it's pretty bottomed out. I'm not saying it can't find another lower level over time, but if I try to do some kind of a shorter-term hedge, if the markets were start to roll over, and I would agree with some of the statements here that a multi-week decline would be nice to see, then being in the VIX during that decline will be a great trade. And I think the risk on the downside of owning that is very limited. So those are two ways that I play for a move on the downside in stocks when I think that it's actually happening.
Do you run into a lot of trouble because the VXX is based on futures, and they don't always do what they're supposed to, and
yeah,
kind of messy?
Yeah, that's what I like about it.
Because, you like that? That's cool.
Yeah,
that's cool.
No, that's why I said it only works. It only works when the VIX is depressed, because what happens is that once the VIX explodes out, then it's totally messy. Now keep in mind, I'm looking at it over a couple of days, maybe a couple of week time frame. So once the market looks like it's topped out, if you buy the VIX, you could be wrong by a couple of days, and the VIX and the market might have a big up day to the upside, but the VIX won't get crushed. Counter to that is that if the market does go lower, the VIX will explode. It's not a one-for-one, and the bias works in your favor. But you have to do it when the VIX is down. You can't try this. You can't think that you're okay once the VIX has popped. So that's what I mean by the mess. The correlation isn't clean.
Yeah. Yeah, I mean it gets really I'll hold up for my answer till for when it gets to me. But let me just answer the prior question. As far as what I'm watching, obviously I'm going to watch the S&P 500 The bottom of the trading range will be very concerning to me. As long as we stay above that range, as long as we stay above the 200-day moving average, I'm not going to get too excited. Let's say 2050, if you're looking for a number, if we stay above 2050, which is somewhat towards the bottom of the shorter term range, I think we'll be okay. I do like this, the climbing of the wall of worry, but this market has really been faking out. It's had fake outs of fake outs. As I wrote, actually, as I write quite often, a market will do what it has to do to frustrate the most. And we were breaking out just about a week and a half ago to all-time highs in the S&P, and it sort of looked like the all clear. And then we sold off really hard. Then we bounced right back. Then we paused. Then we sold off hard. And then looks like we're trying to recover today. So it's kind of all over the place. I think you have to be careful not to chase your own tail. If you're long, stay long and have some stops in place, and just be really picky on any new positions. Obviously, I've kept an eye on the bonds. Not a good situation there. It's not the absolute level of interest rates because they're pretty much zero. It's the delta, the change in interest rates, which has me concerned, and eventually that will put a little pressure on stocks. I'm still bullish on oil. We're long oil. The energy stocks, we got knocked out a few of those, but so far it just looks like a pretty serious correction there. Metals and mining, we were long that area, but we got stopped out, and it looks like it's going back down to trade to its old low. So it's a little kind of messy all over the place in there. It's kind of a bummer because these commodity areas have been really paying off nicely. It's by the stupid sideways market. But now we might be entering a phase where we have to sit on our hands for a little bit. And the only other thing I want to add is that, I guess I had a lot of time to think while the computers were down, is that everybody thinks the market has to go down because it's summer, and that's simply not true. Now, there is some evidence that suggests that it does go down after June, but that's a completely different conversation. The market can trend any year, any month of the year, or even in summertime. And I think we've gone sideways for so long, and as you guys here know, traders don't agree forever or don't agree for very long. So I think we could see a meaningful move one way or the other. And I sort of couched in this morning's column by saying that I think the market could trend this summer. So if it sells off hard, I'm going to say I told you. And if it blows up to the upside, once again, I'm going to be right too. But as a trend follower, I'm just going to follow along and not try to outsmart it. Okay, a little mixed up in where we are. I think we're still on the. I think we're on the last question, and it goes to you next, Glenn. What sort of hedging or portfolio protection strategies do you implement in your trading plans?
Yeah, I'm glad you repeated the question, Dave. I had forgotten for the
moment.
Yeah,
sorry about that.
No, that's okay. I'm trying to absorb some interesting points, and I agree with the point that Geoff was making about the VIX. In my own accounts, I'm not hedging that frequently. I'll put in a stop at a threshold of tolerance. But in my teaching and in terms of conceptually or generically speaking, I'm going to select or identify, hopefully in a broad sense, a fixed delta band, and that I can tolerate. And when I see the deltas transcend or move beyond that, then I'll construct a hedge to neutral out the deltas, I guess, in a broad sense of thinking about it. But other than that, again, and then to maybe a little more detail there, my idea is reducing risk versus increasing cost. So the frequency with which I'm going to adjust that hedge is going to hopefully take into account where I am in the risk profile. And in order to do that correctly, I've got to establish my own risk tolerance level. Am I risk averse? Am I neutral or risk seeking? But yeah, I'm just standard hedging if I'm going to do that. But again, typically in my own trading, because my time horizon is not, I'm not usually position trading out that far. I may hope my position trade may be of anywhere from a few days to a few weeks. So it's not as if I'm going out and I'm putting on a position that I intend to lift with a corresponding hedge a year or more out. If I were to do that, it would be some kind of dynamic hedging regime that I would employ, just having identified a delta band. Other than that, I wanted to say, I think I heard you say, Dave, you were bullish oil. So again, at the risk of being controversial, I'm looking at everything from that bottom from, was it March 18, I think, through the recent top as the correction. I think we have another leg to go down in the energy sector. And so that's why the point I was mentioning earlier, I would be surprised if we see any surprise out of what is it, Vienna this week. But I think whatever does come out will be putting pressure on the oil prices, so we see another leg down there. After which it might complete the bear market.
Yeah, I mean, your major trend is still lower there. We're playing an emerging trend pattern. We've already taken some profits off the table, and we have a trailing stop up to break even. So if it works, it's going to work big for us. If it doesn't work, we're going to get stopped out. But I hear you. I mean, the big, I'm always guilty of drawing the big arrow in the chart. The big arrow in the chart still points down, but the smaller arrow is pointing up, and I think we might be turning the corner. But hey, I could be wrong, and that's why I have a stop in place.
Or I could be wrong as well. We'll see. And yeah,
there's that controversy again.
Yeah. The other point I kind of watch closely, again, looking from an intermarket standpoint. If my primary interest for the moment is in the equity in the stock market, I closely monitor bonds. I'm actually short the bonds from 157. I'm projecting some support around the 151 area. I think where are we before I tuned in? I think we're around 155 something. But if we take out the recent top of May 8th, and I'm talking about the front month and the bonds, then all bets are off in my view and on the short side, and then I'll kind of reassess my short thinking on the bond market. But as far as interest rates, and I think there's not much, little if any room on the downside. So we will see a hike. I am just projecting it's not going to come until the next year, first quarter of 2016 at the earliest. I don't think.
Oh, they're going to put it off as long as they can. This new Fed is not a do what you're supposed to do. This Fed is let's just hold off and hope the market keeps going higher. It's a total different Fed. I mean, you guys, everyone here has been around the block a time or two. You guys remember years and years ago, you'd be at pins and needles, and it was a quarter point, and you have a little knee jerk, and then you would always be like, "Come on, give us something," and they give you like a quarter point. It just was crazy.
Right.
But nowadays, it's just ludicrous. Okay, Jeff, I didn't mean to cut you off. Glenn, was that all you had to say on that?
That's pretty much it. Yeah. The only other thing I would add to that is that, again, from when I'm teaching students, if I have a smaller portfolio or level of equity, more specifically, I might implement some type of collar strategy. But that's pretty much it.
Gotcha. Okay, Jim. Same question to you. What sort of hedging or portfolio protection strategies do you implement in your trading plans?
Okay, I'll get into that in just 1 second. A couple of things hit me that I just wanted to mention, maybe might be helpful to people. On the stock market, one thing that I've been watching is that Russell index because, of course, the 2,000 stock window. Yeah. And I noticed on a monthly graph the month of May and March are lower than the month of April. And I'll be interested to see if June and July would lend to more of a rollover because of that chart formation. So I think the Russell indicates a little bit of a exhaustion with that move that we had in April, because that high in April is now surrounded by lower highs. Just something to keep an eye on.
No, I'm glad you brought that up, because that's one thing I forgot with all this technical problems here is that the Russell, at least on a daily basis, is a big old head and shoulders top looking pattern. But the good news is one or two big updates would negate that. And then I forgot who wrote about it. I want to say, I'm going to give Van Thorpe credit for it, but he called it the hounds of the Baskerville signal when the market does something it shouldn't. Like it should go down on its head and shoulders, but I think it can go up and kind of dovetail in with what everyone else said about the sentiment and all. So that's kind of an interesting thing to watch. And the next question is, though, in the hedging thing, what sort of hedging or portfolio protection strategies do you implement in your trading plans?
Well, basically on the Option Professor DVDs, the two main ones are married puts and the collars. One is obviously you're trying to hedge a specific position, and the other ones you're combining covered call writing with put buying, and those are discussed at length. In addition, there's other ways to do hedging when you're trading the S&P big contract by using other forms of the S&P like the E-mini and different kinds of work in concert, which is a little bit more involved than we're going to get into in the short format here today.
Yeah.
One last thing also is on those T-bonds that you guys were mentioning. I noticed that it's kind of setting up a bit of an ABC or 1, 2, 3 formation because it bottomed at around 150, jumped up to 156, pull back today to 153. So obviously, if it holds down here and starts blowing out 156, that would be really positive for the bond market. And likewise, if we start blowing out 150 or 126, 124 on the 10-year, the interest rate picture might be getting a little bit muddy. So we're coming into a pretty good period of time where we might start seeing a lot of things hit the fan.
Yeah, and it's kind of interesting. I mean, usually in summer you just get bored to death, and I hate having to be here a lot of times, and I'm dragging that laptop around with me all the time too, just in case. But this might not be one of those summers. It could be interesting. I agree with you. Once again, no controversy.
Yeah, one last thing on the gold. You guys were mentioning that some of the gold stocks had gone into the fade mode. If we get oil into the deflation mode and we got the dollar spiking up with some kind of strength this summer, it might be the fuse that needs to be lit if gold's going to blow out their lows at 1140 and maybe take a traipse down to the 60% correction area, which would be sub 800, which would shock a lot of gold bugs, but it is certainly not off the table as far as a possibility. So the rest of this year could be very interesting for the gold if it can hold that 1140 mark and it's combined with some strong dollar and some deflation. The gold could really, get onto a pretty slippery slope.
It's amazing. Intermarket technical analysis only matters when it matters, and I'll tell everyone to read Murphy's book. Intermarket, where is it? I'm trying to find it on my bookshelf. But Intermarket technical analysis is the name of it. But it only matters when it matters. And even Murphy says there's long lead and lag cycles. But right now seems like a point in history. I'm glad you brought all that up, Jim, because everything's kind of all coming together, and it's gonna be fascinating to watch unwind. That dollar rolling over has just been a boon for us because the market's going sideways and all these commodities were taking off, and we were just having a blast trading them and doing really well in spite of a sideways market. But now all of a sudden the dollar decides to go back up, and it's kind of muddying the waters a little bit. And it's interesting what you said about gold, because gold looks a little iffy in here, and with that dollar coming back, it's going to put a little more pressure on it. So good observation on that. Again, no controversy this week. I didn't get a chance to introduce myself at the beginning. I'm Dave Landry, and I just want to explain a little bit about my trading style. It's sort of as part of the answer I want to give on the hedging thing. I'm a short to intermediate term trader. I only believe you can predict the short term when it comes to markets, but you can stay with a position as long as it moves in your favor, and hopefully that's weeks, months, and even years. Even though I say I'm intermediate term, that's because we usually get stopped out within a few weeks or a few months. But we do have some positions that were put on last September, and hopefully if Timing Research and David Kosmitter has me back next September, we'll still be talking about the same positions. But if you're interested in methodology, I have a 21-page report on my website, DaveLandry.com, you can check out. And the rest is just details. That's going to give you the crux of the methodology. Now, I wanted to set things up so I could explain my take on hedging. And it's not my way or highway. And maybe this is where I bring a little controversy to the show this week. But my experience with hedging is, let's say you hedge a position and you're long. You're long the underlying stock or the stock market, whatever the case may be. So you buy a put. Now, I know there's more complex ways to hedge, but let's just say you buy a put. Well, if that market goes up, your put's going to go down in value. So you're going to make some money on your long, but you're going to lose some money on your put, and then you're going to have to reset that put. Now, if just the opposite happens, you're going to make some money on the put, provided you get the timing right and the magnitude right, but you're going to lose some money on your underlying position. So for me, it seems to turn out into a big wash. So I would rather be a directional player in that I take a short-term profit and I bump up my stop STOP to break even. Right now we're at break even in USO. We've got one leftover oil company we're long. We're long uranium. We got a stop in place. And so by taking that partial profit, just in case a longer term trend doesn't materialize, that's my way of sort of couching without actually hedging. I'm taking some money off the table, reducing my exposure, but my position is still big enough to where if the trend materializes, it could be a wonderful thing. Now, Geoff talked about earlier buying the VXX. I would caution those who are a little bit newer to trading and don't fully understand these instruments to run but not walk away from them. Obviously, Geoff's got some strategies and some experience in place. I'm not trying to create controversy, Geoff. I'm just saying that the average person does not understand how these things work, and they're very complex because you're trading a derivative of a derivative, and it might even be an extra derivative in there somewhere, and it can get really complex really fast in those. And if you, I think they actually, VXX has been split or unsplit or resplit a dozen times. And Jeff, you know anything about that? The splitting of it?
Dave, no. To steal a play from your thing, I'm a VIX trading moron. You don't have to put so much thought into this. The VIX is really simple. It's emotion, right? So when that thing's going up, it's because people are afraid. And to agree and disagree with you, if you try to figure out why it's going up and the math behind it, you'll go in circles and it's not worth it. It's a short-term way to profit from when people start panicking in the stock market. And if you try, so don't trade it for anything more than that. Trade it purely technical. It could be eggs, it could be potatoes, it could be uranium. It's just a chart. But the thing that's cool about the chart, and I stumbled on this by accident. So I'm telling you, it was like a moron that just realized there was a relationship here, which was I thought I was going into the VIX and I was going to be savvy about taking a position in VIX to be short the market over a period of weeks. But I quickly discovered that I had completely lucked out because the VIX had gotten crushed, and I was wrong. The stocks were going up, but the VIX wasn't going down. Then I thought I was smart. I thought I had actually discovered something, right? But then when I tried to do the same thing after the VIX had exploded a little bit, I got my ass handed to me.
Yeah.
Because what happened was the opposite. The stocks went up and VIX went down even more. So the time to do it is when VIX is basing out at a really low level, and it's a very short-term strategy.
Okay.
So,
No, I hear you. I hear you or not. And I wrote some VIX systems back in the late '90s because I was involved with Larry Connors, who was he was just like obsessed with the VIX. And I took a little bit of his research and took it one step further. And I was actually doing some research along with him at that time. So I hear you on that. I'm just saying that a VIX future, an ETF on a VIX future is a very complex thing, and you need to really understand what you do. It sounds like you got your head wrapped around it, so that's cool. I will agree with you if it's low levels, but in addition to that, if it's stretched one way or the other, as you have observed, when it stretched to the upside, that rubber band snaps right back. I no longer do that trading. I'm just a trend guy. I don't try to figure it all out. Back then I did. I think we all have to find, as somebody often says, our wheelhouse and what we're comfortable with in trading. And I prefer to be the trend follower and hold on to that trend for hopefully weeks, months, years. But I hear you, that mean reversion, if you are going to trade mean reversion, then absolutely do it in something like the VIX. And I think it could actually work. But just make sure you understand what you're trading, and you've got your head wrapped around it. You know what's going on. So I'm not going to, again, no controversy.
And to your point, one of the things you do have to worry about, and I've cautioned other traders on this, is that the mistake that traders make is they think they can buy the VIX and then they'll be okay whenever the market goes down. And for all the reasons you just described, it doesn't work that way. The thing just seems to erode no matter what. And
yeah, well, no, it was at 7,000. If you back it all out, it was actually at a level of 7,000 split adjusted back whenever this thing came public, like 3 years ago or 2009, whatever it was. So you can't just say I'm just going to hold on to this and it's going to be a hedge, because they'll just keep resplitting it every time they roll over. But,
yeah.
Okay, cool. No, you know what you're doing, so that's interesting. But yeah, I just think hedging in general is a bad idea. But if you have some little strategy you can implement like that shorter term, even if it does use the VIX, I hear you on that. Jeff, while we're on you, any closing thoughts or anything else you want to tell us about MarketGauge.com? And it could be about anything.
Well, my one closing thought to relate to what you guys were saying earlier in IWM. It was interesting. I forget who said it, but they mentioned the monthly chart, and so I thought, oh yeah, I should look at the monthly chart. My take on IWM is, from a big picture, is this thing's already broken out. And while yes, I don't like the fact that it seems to be weak here, if you look at the monthly, the picture that I'm focused on is very clear. It's broken out. It's just consolidating above the highs. Until we take out 120, the IWM is still somewhat of a leader in its breakout and consolidation. So I think that's a slightly different perspective than we were talking about earlier. And as far as market gauge, as I said earlier, probably one of the easiest ways to kind of get to know us is to just go to marketgauge.com /tutorials, and you'll find some videos and good free stuff there.
All right, appreciate it. Yeah, I'm looking at that monthly Russell. You put like a 50-day moving average on that, and it's well above it, and it has been for a long, long time. So that's kind of interesting. But yeah, shorter term, little iffy there. Glenn, let's go to you next. Any closing thoughts? Anything else you want to tell us about PacificTradingAcademy.com, the markets, or anything else?
Sure. It kind of following through on what Geoff said too. I think it was Jim who mentioned a point earlier in terms of we're kind of at a interesting point in the bond market in particular, and I think that's what it is. It's an interest rate play. I think it's a long-term bet the Fed's going to ultimately raise rates. I think the question is, if you look at the high, is everything from that high, is it an ABC correction or is it a new bear market, 1, 2, 3? And that's kind of my thinking. I'm placing my money, and I have a slight bias of selection to expect it's going to be a new bear market. I could be wrong, and that's why, to your point, Dave, when my hedge typically is identify a zone of resistance above which, if I cannot tolerate any capital further loss or incurring. But I think that's a big thing. And as rates go, so too will the other sectors, the stock market and so forth and so on. So,
yeah, I agree with you on bonds. Again, no controversy, because we made a top in January, and the market made a bow tie down, which is a crossover of 3 moving averages over a short period of time. And sometimes you get a little swing trade out of that. And then sometimes it'll become the mother of all tops, and sometimes it becomes both. And we had that little throwback up, and I know as someone who looks at retracements and all, you probably were looking at that back in March where the bond market went back up. But it stalled well short of those old highs. And in my experience, when you get that first sell signal, then you get that throwback up, and it doesn't take out that old high, that usually is quote-unquote the top of the market. So, again, no controversy this week. I'm going to go ahead and agree with you on that. Any other thoughts about Pacific Trading Academy or anything else you want to let us know?
Yeah. Again, we've been operating for almost 15 years, and I've been trading for a lot longer than that. I'm curious, is the Jim that's along with us today, is that Jim Flanagan? It sounds like him, his voice.
No, I'm Jim Kenney.
Oh, Jim. Okay. Yeah, I didn't know, because I did a lot. Years and years ago, when I started at 24, I was reading a lot of Flanagan's reports on the long-term cycle stuff. But in any case, yeah, I've been teaching since with PTA, Pacific Trading Academy, for about 15 years. Right now, again, in my own accounts, I'm primarily focused on the stock, on the S&P, the E-mini, and do a lot of forex trading. But I have worked pretty much in all sectors or instruments, options. The only thing I'm not trading right now, and I realize that a lot of guys and a lot of discussion has been on individual stocks. So I started my career there. I just, 35, 36 years ago, I would buy stocks and they would just sit there. So the average amount of volatility today is significantly different than it was then. So it was harder for me to earn a living then, so that's why. But the technician part of my thinking looks at this stuff as lines on a screen, more or less.
Yeah, amen.
In the bigger sense, I follow the trend. It's become a cliche, so that's first and foremost my view. The only thing my personal repertoire or way of seeing the world would incorporate along, or as a complement to that, is I believe, and I know it's a minority view, that the reason we see the type of price returns we see is due to certain time elapses. So timing is a big, that's that GAN part of what I do. As far as the teaching that I do, I attempt to create curriculum that's going to tailor to the individual needs of the student, and then we've got other traders that focus on stocks or different types of trading fundamentals, you name it. But again, whatever, to the extent I have had some experience in certain types of trading or sectors, that's what I provide to the traders that come into our program at PTA.
Cool. Okay, sure. Jim Kenney of OptionProfessor.com. Any closing thoughts?
Just
else you want to tell us about? Go ahead.
Sure. Yeah. Just on Option Professor, they're going to be having 4 webinars this month. Tuesday, Thursday next week, and Tuesday, Thursday the following week. So if you want to jump on to one of those, you could learn more about the uses and risks of options, which is helpful. And some closing thoughts, on this stock market. Again, we've had some deterioration in things like the transports and the Russell, but the market's hanging right in there, and it's either going to be able by the end of the week probably somebody will light a fuse to make the selling come in, or this lack of liquidity and everyone getting relatively short. And if everybody has to cover at the end of the week, we could go right through the highs for all we know, because again, the liquidity stinks up here. And if everybody's doing one thing or the other side of the market just drops the bid or raises the offer way up. So I think by Friday, the volatility may kick up quite a bit. So we'll have to see what happens here. It's going to be exciting.
Amen. It's cooking. We're running a little long, so let me just wrap things up quickly. I do DaveLandry.com. Obviously, I answer my own emails, Dave at DaveLandry.com. So if you have any questions or anything you heard today from me, feel free to ask. It's not my way or highway, and I realize you guys have different ways of doing things. Again, we still didn't have much controversy this week. But I do a weekly webinar. I'm glad you mentioned those webinars, Jim, because I do a weekly webinar every Thursday, and then every other week we do just a strictly more of an educational one. But in Dave Landry's Week in Charge, which is every Thursday at 11, what I do is I flesh out a lot of the things we talked about today. We'll look at the transports, the Russell 2000 that is, and then some of the techniques to stay with the trend. And sometimes money management and psychology, which is one of my favorite things. And once we do that, we get into the individual's questions. They could be on anything on trading, and we also looked at individuals' picks. So we tend to have a lot of fun there. We don't take ourselves too serious. So if you have a chance, join us on Thursdays at 11 a.m. and that's that's Eastern Daylight Time. All right, David Kosminder, back to you. Thanks for putting up with me doing these technical difficulties today, and my apologies on that.
Oh, no problem. Thanks, guys. Want to tell everyone who's watching that first, the hedging question for this week was actually submitted by a subscriber in the comments section of the survey a few weeks ago. So if you are watching and you have a question that you'd like us to, that you'd like to see in a survey and the people on the show discuss in a future week, just feel free to submit that in a survey or go to TimingResearch.com/question. Also, if you haven't seen the most recent report or want to download any previous reports, just go to TimingResearch.com/reports. And sometime later in the week or this weekend, go to TimingResearch.com/current survey to fill out the next survey. So I just want to thank my guests, Geoff Bysshe of MarketGauge.com, Glenn Thompson of PacificTradingAcademy.com, Jim Kenney of OptionProfessor.com, and of course Dave Landry of DaveLandry.com. Thank you for hosting, Jim.
Thank you.
And thanks, guys.
Thanks, everyone.
Yeah, appreciate it, Dave.
Thank you, guys.
Thanks for having us. Bye-bye.
Thanks.
All right.
Bye-bye.
Thanks. Bye.
Bye.